Well, good afternoon, ladies and gentlemen, and welcome to the Research Insights session at this year's EPRA conference. My name is Alex Moss, and I'm chairman of the EPRA Research Committee. And each year on the Research Committee, we commission and publish research from both academics and practitioners, as well as producing our own EPRA research products. And also, I'd like to mention that at every research conference, every EPRA conference we have, we also ask participants for their suggestions for topics of research for the forthcoming year. So please feel free to forward us your suggestions for research ideas that you think should be commissioned for the coming year. So today I'm absolutely delighted to introduce two panelists today, Sabina Kalyan from CBRE Global Investors and Mahdi Mokrane from PATRIZIA. The format of this session this afternoon is going to be that Sabina will present her economic outlook as it relates to the global real estate sector for around 15 minutes, very short time for a very big topic. So we will be succinct, and then Mahdi will follow with his response. And during that time, please feel free to put your questions forward via the question box. And then what I'll do for the last 10 minutes or so is have a look at those questions and put those questions to Sabina and Mahdi. We will then hand over to the panel discussion, which is being chaired and moderated by Struan. So thank you for your attention. Thank you for attending. And without further ado, I'd like to now hand over to Sabina.
Thanks, Alex. I'm hoping you can all see my slides. Yes?
Not yet.
No, I haven't been given the prompt to share them, so. I'm not sure.
Hi, Sabina, you're already the presenter.
Oh. Well, I don't have a prompt to share my screen. Can you walk me through what to do there? Or do you want to share the slides? Wasting valuable time. Ah, there we go. Lovely. Now, hopefully you can all see my screen. Apologies for that. Okay, so I've got 15 minutes for a really rapid run through of what we're seeing in the market and our outlook for the global economy. But as Alex said, you know, this is a research session, so I wanted to really do it in a meta way by talking through, as a researcher with a background in economics and real estate, the different ways in which we're having to use data that is unconventional to come up with a view of the outlook for the pandemic as a first step in figuring out how we think the economy is going to evolve and therefore the real estate markets. So what we have here is a simple graphic showing a wave chart, and behind this goes a lot of data from the World Health Organization and other sources that give us a sense of where confirmed cases are, which is obviously different from actual cases, and the death rate, sadly, and trying to back test from that where we are with R. So here we have the first wave. You can see that America is on the downslope, Sweden too, because it had a very unconventional means of dealing with its lockdown, which may indeed prove to have been the best way forward. We'll find out in time. A lot of the European markets are at the bottom of that first wave, having successfully brought it down over the summer. But of course, as we all go back to school and to work, we are watching very closely the reproduction rate to see where we go. And actually, I redid all of our R estimates this morning, and the UK, on my estimate, is already back up to 1.25. So you can very much see us entering that second wave. What you find is a lot of the markets that have more tourist-driven economies are further up that second wave, such as Spain, France. And then as you get into that second wave, you have a lot of the Asia Pacific markets. And there is an argument about categorization here. Some of them, such as Hong Kong, classify themselves as on the downslope of the third wave because they believe that the second wave for them was when they'd come off the first wave of domestic community transmission, but they started to get cases from people coming back from airports. But actually, when you really get into the data, that doesn't really look like a wave in its own right, and I think they're on the downslope of the second wave. And I think, sadly, we will go through a second wave in Europe and probably even a third wave before we get to the point where we have an effective therapeutic and vaccine combination that allows us to really get our arms around what's going on at the moment. But of course, as real estate investors, we are looking at cities and sub-markets, not necessarily countries. And here we have a wave chart just showing where some of the states in the US are in their waves. And it's hugely different. You know, places like New York, Massachusetts had that horrible rise in infections and deaths early in March, April, but really have brought that down and kept it down. Whereas, you know, Texas, California, some of those other states really never got over their first wave and saw it ramp up again in the summer as they reopened their economies and are only just getting their arms around it. So it really does matter where you are and the local jurisdiction and how they're dealing with a pandemic. If we look at overall how we in Europe line up against the rest of the world, I love this data source. This is a new one from the Blavatnik School of Government at the University of Oxford. And they look at all the various lockdown and stringency measures, whether it's school closures or restriction on public meetings, and index them from 0 to 100. So on this map, as you're in the grey markets, which there aren't any here, you're very low in terms of lockdown. As you get into the green, you're getting more restrictions on movement. And finally, as you're up into the orange and red, you really are very locked down indeed. And as you can see, Europe, from a global perspective, is actually the least restricted place at the moment, because we are at the bottom of that first wave and not yet rising up the second wave in general. So to a certain extent, the kind of mobility we're experiencing right now is rather unusual from a global perspective. But as I said, again, this is very city related. So Australia in the light orange there, but if you were in Melbourne with incredibly strict lockdown, it would probably be up in the red. So this really does have a bearing on local market economic activity, leasing activity, confidence in deal making, and just the sheer ability to get to go around and inspect properties and do deals. In terms of how the waves might hit, I think there is a perception and maybe a complacency that having been through the first wave, the waves will then attenuate, right? You know, particularly in somewhere like the UK where we didn't have a very good first wave, surely the second wave can't be as bad. This is a little bit of a warning from Australia. So you can see here on the left-hand slide that the new cases per week were much higher in their second wave than in the first. And indeed, so was the death rate. So it was a really nasty second wave. And they have, however, if you look at the right, managed to get their R down, largely by clamping down in Melbourne and to a lesser extent Sydney. If you want to know how I calculate R, that's a question for later. We'll estimate it. But it is basically by looking at the death rates and the cumulative infection rates and trying to back out an implied R from that. And it does show in a lot of Asia Pacific markets and indeed a lot of US markets that R is now on the downward slope. Whereas if you look at a lot of European markets, it's definitely picking up again and quite, you know, alarmingly over the last week or so. That said, it's not all doom and gloom. And, you know, there is a sense in which the people who are now moving around the economy are the young and the people without pre-existing conditions, and that one should see a fatality rate that's much lower in the second wave, one hopes, going forward. In terms of the underpinnings of our macroeconomic and real estate forecasts, we have to have a view, right, on what the therapeutic is going to be and when we're going to get a successful vaccine. And we're not complacent. We know that we might not get a vaccine at all. Coronaviruses are very tricky. And also it might be a vaccine that you have to take boosters of and doesn't give you long-term immunity. Nonetheless, we feel that when we're doing our economic and real estate forecasts, when you get to a point that people have confidence that they can move around the economy in a way that has the normal kind of risk, that is when we will see our above trend growth again and our leasing demand truly pick up. So we need to take a view. And on this chart, I've got, you know, an incredible array of colors here. So don't worry too much about the detail, but look at this huge clustering of activities you get into Q4, Q1 of next year. What I've done here is there are a huge number of vaccines that are currently on trial. I've just shown the ones that are currently in phase 3 or announced phase 3. And you can see that there is a big clustering of activity over the turn of the year. And, you know, we're fairly confident that by sort of Q1 of next year, you should start to see key workers being vaccinated and hopefully the rest of the population as we get into Easter and summer. Of course, this can go back and forth. We've only just heard that the AstraZeneca trial is now pausing, very rightly so. But this kind of underpins the macroeconomic picture that I'm very quickly going to take you through now. So our basic global outlook is underpinned on a Nike swoosh recovery. So people have V's, W's, K's. Ours is a Nike swoosh. We have that very sharp slowdown in the first half of this year. We then have this faltering recovery in the second half of this year and into next year as we kind of come out of lockdown, go back in again in a localized way as we get into second and third waves. We all know that we're working, but it's not quite normal. But then as we get, hopefully, a rollout of a vaccine next Easter, next summer, that you get a really nice boost to your 2021 recovery growth into 22. And then we see growth actually above trend for all major markets into 25. So actually, the numbers from 22 through 25 are pretty good, and one hopes that you'll see some commensurate real estate returns on the back of that. That said, there is a permanent loss of output. The supply side is constrained, and we never quite make up that lost activity. And most importantly, as real estate investors, the private sector really lags in this recovery. So next year, you have a weird pattern whereby a lot of the headline GDP numbers are really good because government spending is sloshing about, and you do have some good base effects. But the private sector is still feeling the ill effects, and actually you could start having a fair amount of job shedding as some of the furlough schemes run out. So another thing as real estate investors that we're really keen on doing is looking at local country furlough schemes, what the support is to employment, so that we can try and time where we see private sector consumption and occupier demand coming in. So we're having to be very detailed in that. Another issue that we're trying to get very focused on is the debt level in the economies that we invest in. Evidently, everyone has taken on a lot of debt to fund furlough schemes and subsidies and all the rest of it. And the question we're asking ourselves is, what does each government do in response to that? Do they let it ride, Japan style? You know, keep interest rates low with central bank intervention, in which case maybe that has very little impact on consumer spending. But if you're in a market where governments will feel under pressure or constrained to raise taxes to pay some of this down, that could have a very solid impact on some of the fundamental drivers of our real estate forecasts. And actually, we're seeing this at a super local level. You know, we're starting to see at the margin in certain municipalities in the US where they were already basically bankrupt and raising property taxes, the idea that people might want to occupy an office in a different jurisdiction within that overall metro area because they can see the current and future burden of taxation being lower. So I think this is going to be a real focal point of micro analysis going forward. The other big debate, and we are, I guess, on the bullish side of this, is whether this incredible amount of fiscal spending is going to unleash inflation, either because there's just so much liquidity sloshing around that you get some upward price pressure, or for the more nefarious reason that, you know, governments are deliberately trying to monetize their debt and they lean on the central bank to help them do that. You know, when you're at the limits of policy, the fine line between independence and non-independence is finer still. I think our view is that there's so much spare capacity now, given the pain that we've suffered in the first half of this year, that we are in the early 80s pop song turning Japanese. In other words, that we can sustain a fair amount of fiscal and monetary expansion without seeing inflation run away. Of course, we are monitoring it very closely and looking at all the standard macro indicators, but we feel that this is more an issue for maybe 4 years' time than the immediate near term. And then to sort of misquote, I was told yesterday by Colin Nasieri that Keynes didn't actually say this, but something that's attributed to him is markets can remain irrational longer than you can remain solvent. And I think the idea here is that markets can remain manipulated longer than you can stay solvent. In other words, betting on higher bond yields and higher inflation and a sort of central bank failure in that regard, I think you probably have more issues to worry about than higher inflation if central banks could no longer really effectively control the yield curve. But this is we could do an hour on this alone. In terms of wrapping up on our key calls for the real estate outlook, we just did a whole new set of real estate forecasts in May, and we're currently doing another one. But I think the key messages remain in place. We ex ante, before COVID, we had been wondering if retail was becoming so cheap that at some point it would be the right time to come back in to the very prime resilient stuff that hopefully had a future. And our forecasts just don't show that recovery. So insofar as there might be opportunities to go into retail and maybe convert to resi for the underlying land value, maybe that's a play, but honestly, the numbers just look really horrible. The office forecasts, by contrast, look really good, especially when you get to 2022, but we all know that there's this controversy about the future of office, so I'll cover that in a slide's time. Beds and sheds remain resilient, and that's a problem, right? We all love industrial and residential, everyone's buying it, the prices are getting higher, the cap rate's keener, and maybe that's okay. The implied lower nominal return on that stuff is okay because we live in a world of heightened risk, but it does give you pause for thought. Just a few moments on the office sector. There's obviously this tension, right? If we're going to work from home more because it works, and we're going to go into the office less, does that mean occupiers are going to hand back space? Or because when we go back to the office, we want those connections to be meaningful and collaborative with our clients and our colleagues. Actually, we don't all sit in rabbit hutch routine desk space, but have lovely collaborative space. And so there's more space per person when we're in. So how do you balance off those conflicting structural forces? So what we did in the US is we took our nominal US office rent forecast, that's the dark green line labeled A1 here, and we ran some scenarios, and all these scenarios vary how much working from home there is and how much space per person there is. And you can see the range of outcomes is just enormous depending on your assumptions, so it's very sensitive. What we think is probably the likely outcome is B2 medium term. In other words, there's a bit more working from home, but there's also a bit more space per worker. But in the immediate term, it might look a bit more like A2. In other words, there's not as much, there's more working from home, but we're not getting the beautiful, lovely collaborative space because corporate balance sheets are stretched and no one wants to pay for it quite yet. So we do think there's going to be a bit of a near-term knock to office demand and rent growth. We're still very positive on the best quality future-proof office space, but we are a bit worried about structural forces impacting offices going forward. Lots more work to do there. This is just the US, but just to give you a flavor of the kind of research we're having to get our heads around. And it really is about scenario testing because none of us is a perfect futurologist to predict what behavioral demand is going to be going forward. So in terms of my final slide, what keeps me up at night? These are the three questions. What happens to all that obsolescent retail? What do we do with it as a society? I think this is a really important point, and as investors. What happens to office demand? Is it hub and spoke? Is it more flex space? Is it working from home? Is office the new retail, as the listed market was telling us a couple of months ago? And then what happens to resi demand? If we're working from home more, should we stop building multi-family city centre, live, work, play, resi, and build more single-family suburban edge of town space? So huge structural questions out there, and I can't wait to discuss them with all of you. Thank you.
Fantastic. Well, thank you so much, Sabina, for an enormous topic. Lots of very interesting points there. But first, maybe Mahdi, if you can just give us your sort of impressions about some of the points that Sabina's raised and your experience at PATRIZIA, and then we can come back and hopefully have time for a few questions before we hand over.
Of course. You know, thank you, Sabina. So I think basically, you know, the way our house view has evolved over the last 6 months, you know, has really sort of tried to be, you know, cognizant of what was going on in the market, and of course the scenario testing and scenario analysis. You know, keeping the you know, our people safe was a, you know, massive priority. You know, day one, of course, but also protecting our assets and staying open for business. So I think, like everyone, we try to do the three things simultaneously. And I have to say that, you know, the macro forecast, the impact of COVID, you know, back in March and April, if you look at our, you know, economic forecasters, they flip-flopped around the place, you know, holistically. And I think this is something we have to live with as strategists, as economists, and as decision makers. And I have to say that we have to keep that scenario approach going forward. And one of the key things we've been convinced of is that the fiscal policy that now sort of is superseding on the monetary policy, because there's not so much room left with the monetary, is really where we should follow the money. And I think in that respect, there is a clear north-south divide that is happening in Europe, you know, and we see that, you know, quite clearly. The other thing that came out strongly in Sabina's presentation is that some of the trends that we had been seeing before COVID are just being accelerated. Think of, what has been just said about retail, and we can discuss this further. The millennials were already, to some extent, getting out of some of the major cities in the US before COVID, even, 2-3 years ago. And that, de-urbanization, or that easing off of the hyper-urbanization, the winning cities, this is something we have to keep an eye on in terms of trends. E-commerce, of course, and of course the working from home. But on the working from home, there's one figure that I keep quoting, which is, if you look at the Amsterdam market, for example, about 40%, nearly 40% of the office workers have already a working from home arrangement, either 1, 2, or 3 days or more already in place. And it's not that far if you look at the London market. Paris is slightly behind. And then if you look at Italy and Germany, that figure is probably 5% or even lower. So there are huge discrepancies around the way, working from home has been embraced. But if you go back to Amsterdam, the fact that we're nearly at 40%, has anyone told you about rental forecast or vacancy because of that figure growing over time in Amsterdam over the past decades? No. So if it happens over a gradual period of time, I don't think it'll have a massive impact on office demand, at least not in the near future, but it's definitely gonna happen. So the last thing I'd like to mention is, given all that monetary and fiscal impulse, we kept on saying interest rates are going to stay low for longer, forever. That is something that is now being entrenched. Real bond yields are negative. And now with Canada in June being downgraded down from its AAA, the stock of AAA stock, government bond stock around the world is shrinking to just a nut. It's really minimal. So real estate is going to have to do something for institutional investors. And in that respect, I think, residential, particularly multifamily, has shown its resilience and being a sort of a bond proxy. Logistics, the sheds, as Sabina has mentioned, clearly has shown their resilience in terms of rent collection, and going forward in terms of the ability to push rents a little bit. And I should add that I think food-anchored retail is something, proximity, non-discretionary spending retail, the thing you have close to your home, that has proven also to be quite resilient. For the other property types, which are more exposed to the higher beta, if you want to label it that way, to the economy, I think things could be a bit more tricky, but they will definitely bounce back. And final point, in terms of the bouncing back, is it a V-shaped, U-shaped, Nike swoosh, or jagged Nike swoosh? I think we're seeing more of a K, in the sense that you'll have parts of the economy that will bounce back quicker, and parts of the economy that will just continue struggling, particularly if we have echo COVID episodes, as we've just seen. So this is a very, very quick take and summary.
Brilliant. Well, thank you very much, Mahdi. I have a question actually for both of you, really, just in terms of sort of underwriting of transactions, and also the point that you made, Sabina, about the sort of the micro effect and very, very specific, very localized impacts against what at the moment is a very generic, very broad global impact. And it's a tricky question, but I welcome both your thoughts. Is the assumption that effectively this is a global pandemic and everything is broadly equally affected? There'll be a global vaccine as per your Q4 next year, and sort of things gradually return to normal in terms of capital flows globally? Or is there a feeling that actually people are going to take the view certain areas are going to continue to be more affected than other areas, and have effectively a risk premium therefore attached to them? And maybe this applies to sectors as well as sort of geographies. So in other words, my question is, do you think this is just a generic sort of a risk premium according to everything for underwriting risk, or do you think it's going to phase through and there'll be specific risk premia attached to certain locations, certain property types, certain geographies? Tricky question, I appreciate, but
I think it's very localized, right? Because as we've already seen, how different jurisdictions deal with the pandemic, which is global in its nature, has a hugely different impact on the economic growth and the activity and the real estate performance in those markets, and also the government, responses in terms of what, as a landlord, you can get as a cash flow, right?
Sure.
The whole nature of the relationship between landlord and tenant has come into question. And also in terms of the vaccine can come out, you know, technically as a global vaccine in say Q2 of next year, but who gets it? Like who has pre-ordered those doses, and which order in the population are you getting them, right? So I don't think it's equal by any measure, and you have to have a view.
Yeah, and I think that the way we are reacting, which we think the market will increasingly react pretty much in the same way, is more or less of a barbell approach, where if you have conviction on certain property types, locations, geographies, and for example, you know, German residential or, you know, long leased, you know, offices in sort of very resilient, you know, obsolescence proofed, if you're convinced of that in terms of commercial property, then in that case you can take a longer term view, and you know the underwriting is not necessarily going to change massively. And on the other hand, anything that is going to need, you know, capex, repositioning, seeking a tenant or a series of tenants along the way, that uncertainty that you have to model, you know, thinking in scenarios, is definitely going to drive your risk premium, you know, your required return upwards to compensate for that additional, you know, uncertainty and risk. And we know, and we've seen that in the last few weeks, you know, governments sometimes tend to be quite erratic in the way they respond to the pandemic, which, you know, doesn't help at all. And in some sectors, it actually is pretty detrimental.
Interesting, and I take your point, Sabina, about different government responses economically, because if you look at the furlough length, for example, throughout Europe, it varies dramatically between the UK and the rest of Europe. But I guess the other point I was particularly interested in, and it comes to you as well, Mahdi, is that, you know, the UK historically, and it's obviously been reducing, had this incredibly landlord-friendly, long lease length, fantastic sort of generic pension fund investment
maybe
characteristic.
That's over, right? I mean, this idea that you
in
invest
those halcyon days.
The last time we had, you know, a really global exogenous shock, the oil shocks, the government's enacted upward only rent reviews to protect us lovely landlords. And, you know, this is a very different time. Coming off the GFC, it's a very different political time. The ex-ante social fabric was different. People, because 2020 is so radical, we forget that 2019 was a very radical year with Me Too and Black Lives Matter. You know, we don't come to this from a clean sheet of paper. So I am obsessed for the idea that the way we underwrite cash flows will have to change, because the certainties around we will always get paid. If we're less like a bond and more like an equity, where should we sit in that multi-asset risk return profile, right? I mean, are we underwriting wrong?
I think,
and so I guess the question for
Alex,
both of you is in the
just
UK.
just on that point, I think, you know, this is the investor's dream, right? Long leases, indexed, upward only rent reviews. That's absolutely perfect until it isn't, until it's a winner's curse. That's just what happened to parts of the retail sector in the UK, which got trapped into that unaffordable sort of rental sort of effort rate. On the other hand, you have, you know, mid-level, mid-income, you know, residential, for example, that could cater to a wide, you know, population, the demand supply imbalance, but you have very short leases. But if the law of large number applies, and then you have something that is very predictable, even if on the paper it has a short duration, it actually is a very good fit for many investors. So I would argue, you know, upward only rent reviews may still be there to stay, long leases for income strips, you know, or, you know, for certain types of assets and locations. But, you know, I think we just have to accept that we will have, again, maybe a barbell type of approach to leases, where landlords, operators, REITs, listed property companies, managers would have to take more operational risk. And then on the other hand, sort of the invest and forget type of approach will be very, very limited.
Exactly. It all seems like a distant dream, doesn't it, really, the invest and forget long leases. And so, and about to take your point, Mahdi, that actually sort of effectively a new replacement for that is obviously where it has been typically operationally, which is where there's long, strong-term demand. And that provides you with the cash flows to underwrite, and that provides you with the cash flows for pension funds, et cetera, et cetera. So in a sense, it's new. But I guess my final question, because we're just coming up for time, final question just on that point. Historically, you know, somewhere like London, and looking at cities, not sort of countries, but somewhere like London, certainly post GFC, has been the major beneficiary of these global capital flows and the landlord-friendly environment. So sort of regardless of sector, is there a way of thinking that actually London might well be the worst affected in terms of a risk premium increasing on it? A, because maybe the overseas capital won't come, and B, because the lease lengths are becoming ever shorter. or not.
Yeah, and London's lost its position, hasn't it, to Paris and now to San Francisco, if you look at the RTA data for the first half of this year.
Probably also
Brexit, I don't know, but
exactly.
It's not
you said it. You know, we had managed for 30 minutes to avoid the B word. Now it's out there. The next panel will have to tackle that one.
Yeah, fantastic. Well, I very much look forward to handing that baton over to them to resolve. So thank you very much indeed, Sabina and Mahdi. That's absolutely fantastic. Loads of food for thought there. Great presentations, great answers. If people do have follow-up questions, then please do contact us. And now I'd like to hand over to Struan, who's going to be talking about a panel session looking at the operational financial challenges posed in today's environment. So thank you very much indeed for this EPRA Research Insight session.
Thanks.
Thank you.
Well, thank you, Alex and Mahdi and Sabina. Very much enjoyed the session, gave us a lot to think about for this next section. I'm Struan Robertson. I'm chairman of Bank of America's European real estate practice. I am working from home. I am, however, looking forward to going back to the office over the next few weeks. And Sabina, you'll be glad to hear I even miss going to shopping centers. So let's try and build on a few of the comments we have here. I'm joined, as you can see from the webcam, by an illustrious set of CEOs from across the industry. Importantly, from different geographic areas and from different sectors, with the exception of Resi. Hopefully we can build on the questions of what are the operational and to a certain extent financial implications of the current environment, of which COVID-19 is the principal one, but I did hear the B word in there. We'll talk about that as well. So briefly to introduce, in alphabetical order of the companies, Olivier Ramin, for me in the middle of the screen on the bottom, CEO of Austria, some 4 billion or more of office focused in Hamburg, Düsseldorf, Frankfurt, Stuttgart, and Berlin, a bit beyond that as well. By Biljana Persson, on the bottom left of my screen here, CEO of Kungsleden, nearly 4 billion euros equivalent, or 39 billion SEKI, of primarily office in the Stockholm Västerås area, Gothenburg, Malmo, and a bit in the Bob and some other places. Ismail Clemente, top right, the one wearing the tie, looking very corporate, looking like you're back in the office already, setting the right example for us. CEO of Merlin Properties, nearly 13 billion euros of assets, mainly, but not only, Madrid, Barcelona, and Lisbon, 51% office, but some retail, we'll be talking about that. Some logistics, we'll be talking about that. And even some, let's call it triple net lease, some interesting long-term lease dynamics. And then on the bottom right, David Sleeth, CEO of Segro, 11 billion pounds of kit in the wonderful logistics space, UK and Europe. And I'm sure that you've been enjoying this crisis in a certain way. David, we look forward to hearing about that. We'll start off with questions, building on this operational and financial question, starting off with Olivier, and then of course, open it up to questions that come through. So first to Olivier. Olivier, you and I were having a conversation, don't know whether you remember this, the end of March, just before the 1st of April rental payments were going to come in. You made a very perceptive comment, which is you were worried that it becomes socially acceptable to not pay the rent, despite all the contracts. What has been your actual operational experience in terms of rent collection? How has that evolved over time, over the last few months?
Well, good afternoon, everybody. And I clearly remember that conversation. I mean, since then, we've been lucky enough in Germany to have probably a few days after we had that conversation, the German government clarifying the rule of the game between landlord and tenants. So actually, the government make it almost impossible to have that debate in Germany. But speaking to other jurisdictions, and probably others can comment on that, it seems to be a different debate elsewhere. The only company that actually also kickstarted that discussion here in Germany was Adidas, which at one stage announced publicly that they would stop paying the rent on their shops, which triggered like a massive outrage in the press, in the German press, and then Adidas has to backpedal and actually end up paying its rent on its shop. But essentially what the government did in Germany, it basically told landlord, I mean, your tenant can suspend their rent payment, but the rent is still going to be due and payable, and you can still charge arrear interest if you wish to do so. And by doing this, actually, they made the discussion process extremely clear, because the rule of the game were clear. And that was a very, very helping move from the government, which basically allowed us to have relatively constructive discussions. Some tenants were coming back and trying to play games around not suspending payment of rent, and what doesn't look. You absolutely have the right to do that, but you need to be aware that you will need to pay us back, and they're going to be an 8% charge, which is the legal interest on that. And as such, those tenants usually did pay their rent on time and punctually. And other tenants have real difficulties. And for those tenants, from the weaker of them, we accepted to waive rent. For the other, we have deferred rent, and we're waiving interest payment. But it's also clear that the rent remained due and payable. So we are back now. In my company, we're back at 100% rent collection for July and August. And I think this was really, the effect of having clear rules set up by the government, not leaving it open with all the uncertainty that it entails. Who bears the risk of a business not operating? So we were really kind of blessed to have that put in place, which makes our life much easier than in other jurisdictions.
What about physical occupancy? You're getting paid, but how many of the workstations, the desks, are actually being used?
So that's an interesting question, because we do see a difference, and I don't know if the other panels have seen the same thing in their portfolio. We do see a difference depending on the nationality of the tenant. And it seemed that, whether you're a French company or US-based company, then your workplace policy is different than you're a German company. German company are coming back more than average, and I think that has to do with the psyche of the pandemic, and there's probably less concern. We had to do how the country have been doing, and more foreign-based company, headquarter company outside of Germany tend to kind of postpone going back to the office to probably after January 21. And so overall, the occupancy in our buildings today is somewhere north of 50%, going up slightly. As a company, we expect to be back in the office in October. I heard, obviously, we're optimistic that there's not going to be a massive second wave, which would change all the plans. But so far, we're seeing people gradually coming back to the office. And again, German company coming back more on average than foreign-based company, which tend to be more conservative from that perspective.
Gradual recovery in physical occupancy difference culturally. So let's actually switch to Biljana. Biljana, what's been your experience on rent collection, physical occupancy? And as Sabina said, what is Sweden doing differently? Everybody talks about it, but I don't think anyone understands what the Swedish exception means.
Yeah, so Sweden was hit by the virus pandemic in March, and it was first a shock period for everyone. And I would like to say that quickly, all of us in the markets and the government and the central banks were working in order to fight the crisis that we were facing. And the Swedish government reacted quite differently from the rest of the world by not closing down the country, the societies, and not having any lockdown. So throughout the whole virus outbreak and up until now, more or less everything has been opened. All businesses are working. Schools, elementary schools, universities have been open. So maintaining the business and maintaining this kind of business as usual has been some kind of a theme over the Swedish, strategy for beating this virus. So the main recommendation has actually been that, wash your hands. If you're slightly ill, stay at home, don't go to work, don't go to school, keep a distance of 1.5 to 2 meters. We're not allowed to be more than 50 people, but up to 50 people, that is okay. Nothing has been closed since the virus outbreak. And we see since mid-May a day-by-day improvement in the markets and actually returning to some kind of a normal, but from a much lower levels, of course. And I'm sure you have read that the GDP decline was not at all as big as in rest of Europe. So the GDP decline in Q2 in Sweden was just above 8%. and the forecast have actually been revised to the positive for the full year GDP decline. Before it was expected to be somewhere between 6–7% decline. Now it's more like 4 or 5% of a decline. So I think this strategy is so far so good. But you know, we're just hoping that we will not be hit by a second or third wave in the same way as the first wave hit Sweden. And I mean, the rent collection has been more or less the same as pre the virus outbreak, and that goes both for payment of the Q2 rent and the Q3 rent. We have also, with some of our tenants within retail and hotels, helped them out during this very hard period by giving some kind of rent deferrals or rent discount. But on the other hand, we have tried to prolong the lease agreement or increase the rent for the remaining period. So it has really been a win-win situation and trying to help out those who have been hit mostly. As you know, 95% of our portfolio is offices, logistic, warehouse, and industrial. And all these businesses have been very good and managing to keep up the business and, you know, paying rents and everything. And when it comes to this physical occupancy, after summer vacation, you can really see a trend shift. You know, people are sick and tired of working from home. So everyone went back to the work, to the offices. They want to meet their colleagues. They want to meet their clients, you know, doing deals and so on. So it's a dramatic shift post the summer vacation. And we have a mobile operator, 3, and they measure how many mobile users are in public transportation during rush hours in the mornings and in the evenings compared to prior to the virus outbreak. And in Stockholm, it's actually around 65% are actually commuting, going to work. And I believe that the physical occupancy in our office buildings is more or less around 60% today, and it's really steadily growing.
Okay. And Ismail, what's happening in Spain? Focusing on office for a moment, what is the policy difference? What's the rent collection? What's the physical occupation reality?
Well, in terms of rent collection, life goes on normally. The government was quick to react and made clear that pacta sunt servanda, so obligations are to be complied with. So collection loss in our portfolio stands on average since March in the region of 0.8%, which is basically the people that simply cannot do it, cannot pay it. As for physical occupancy, we had the trough was around 15% in the middle of the pandemic when the government decreed the general lockdown of the country. On average, before summer, it was in the region of 25%, so taking all months before summer. And now it's slightly above 50% and quickly ticking up, but it will depend on whether we have a second wave or not, and how good the sanitary management of the crisis is from the authorities.
Okay. Well, now it's a slightly tougher question. What's been your rental collection experience on the shopping mall side? Sabina had a tough view on the future of retail.
Well, on shopping centers is a different ballgame, although we have fared, I would say, relatively well on payment morale, etc., not relatively well on cash flow, because we elected on the 15th of March. We took a decision, basically, on the 15th of March, we enacted a commercial policy bonifying, waiving the rent for those clients in shopping centers affected by the compulsory closure of their shops decided by the government. So we thought basically that we couldn't charge rent on somebody who had been forced to close by the government. So that represented around 89% of the population in our shopping centers, and that has caused, of course, the logical hole in our rental income collection for the year. Then, towards the end of the compulsory lockdown, we took a second commercial policy consisting of decreasing bonus on rent, so a decreasing waiver of rents, starting in June at 60% reduction, 50 in July and August, 40 now in September, then 30, 20, and 10 as the retailers move into the Black Friday campaign and the Christmas campaign, which in principle should normalize back their activity in theory, depending on the sanitary management of the crisis. So what this means in plain language is that we elected to waive around from shopping centers only about 55 million rental income from an annual average of 115, 120, depending on the year. Of course, that goes on top of mall income and of variable rent, which we cannot invoice given the circumstances. In terms of cash flow effect, is a little less because we also cut on all the compensation of the senior executives of the company. But in return for taking that decision, we got almost zero litigation. So we have 28 open litigations out of a total portfolio of 1,800 contracts, which is very much contrary to what most of our peers have been doing in the market. They took the hard way, and now is resulting in much more significant litigation. And also on the part that we charge of the rent plus all the common expenses, we are having a relatively low, a very low collection loss in the region of 2.5%. So now, even now in September, where we are invoicing now on average expenses plus net rents, we are invoicing with around 35% rebate compared to normality 100. We are getting around 2.5% collection loss, which is basically the people who misjudged their situation and they are in zombie status and probably cannot recover.
Okay, so you've taken a pragmatic, proactive approach to the reality of the crisis in shopping centers in the short term. But to Sabina's question, will retail bounce back? You're down 35%. Where's it going?
I frankly don't know, but if I have to make a guess, what we are seeing now is that on average we are around 30% down on footfall and around 27% down average across the whole portfolio on sales per square meter. So given that our OCR, our effort ratio before the crisis was in the region of 12%, I mean, completely dissimilar to Anglo-Saxon realities. I mean, nothing similar to the UK or the US. If you want to maintain the occupancy ratio, the effort ratio similar, you will need to go to equilibrium rents in the region of 25% below normality. However, I believe the current status is a little bit exaggerated because we are suffering more than normally in touristic areas like Barcelona, Valencia, Malaga, Palma de Mallorca, in which cases the 80% of the footfall of the shopping center is local. So you take a 30% reduction, but 20% is touristic and you take a 100% reduction. So those shopping centers are, of course, averaging in the whole package in the region of 40-something% down compared to last year. But I believe this is not a situation that will last forever.
Right. The fastest growing portion of your portfolio is actually logistics. Very different story. But to talk about logistics, we can go to David. David, very different experience in COVID. What kind of experience you're seeing on rent collection? I don't think physical occupancy is a question, but importantly, tenant demand in the face of what should be a crisis, but it's different.
Well, it is different. Good afternoon, everybody. Yeah, I mean, the first thing to say is, the lockdown in the UK happened, late March, and it was a pretty tough situation for everybody. And in our particular case, we're operating across 8 different countries where we've got not only different government regimes. I smile thinking about Olivier's experience in Germany, where the government made the ground rules very clear, and surprisingly or not, that's the part of our portfolio that's done very well on cash collections. And then we have all the other countries, including the UK, where the government has put out some very unhelpful guidance and basically said to occupiers, well, even if you can pay, you don't need to pay because we're going to take away the the right of landlords to take any action against you. That's difficult. What also is difficult is that we have a whole variety of different rent payment dates and practices. So, UK, we have these quarter days where, 23rd of March, 25th of March, 23rd of June, and so on, quarterly in advance for most. Some are paid rent monthly. Some of them are of the so-called modern quarter days, so the 1st of April, etc. 1st of July. In continental Europe, we have a whole set of different practices. Some are monthly, some are quarterly, some are billed monthly, like in France, but paid quarterly. So the big challenge for us early on was, how do you get your arms around this, and how do you actually work out? And I have to say, if ever there was a case for moving everybody onto you pay on the 1st of the month everywhere, and you pay by direct debit, that would be a fantastic step forward, because the slight loss of cash flow benefit would make life a lot easier in terms of trying to understand the transparency of who's really in difficulty. So we did a lot of work around trying to get our arms on, around the portfolio, the occupiers, who's having a good COVID and who's having a difficult one. Fortunately for us, most of our occupiers are in a pretty good place. Most of our customers are doing well. We had I think our second highest half year for leasing data in the first half of 2020. There's no sign of it changing in the second half of the year. So the occupier is doing well in most cases. We know some of the reasons for that, of course, e-commerce, data centers, some of the food retailers. We can chat about some of those details later. So generally doing well, but equally there are some parts of the portfolio that are more exposed to some of the challenged sectors. So we have a number of smaller businesses and occupiers that are in cities like London and Paris, and they're providing goods and services to the hospitality, the food and beverage sectors, and those have been more painfully impacted. Some, we've got companies that are supplying theatre production equipment or filming equipment to London's West End theatres, and of course those all shut down. So we've had the full spectrum. So where we are is that we're in a situation where of the rents due in respect to the second quarter, 99% have either been collected, with about 10% that are on a reprofiled payment schedule. The third quarter rents, mostly billed obviously at the beginning of the quarter, are understandably a little bit behind that, but I think we're accounting for 95% of total rents, again with about 14% that's on some kind of rescheduled payment profile. But generally, it's been, in cash flow terms, it's not been a major issue. And our view has been, quite regardless of whatever the government legislation says in each country, is that, we want to help our customer base, get through and prosper. And even those that are finding it tough, if a bit of help with cash flow gets them through the other side of this thing, then it's absolutely the right thing to do. And I think most landlords are taking that view, which is why, case in point, UK legislation is particularly unhelpful, because it's in everybody's interest that you keep your occupiers, even if if you're in some of the more troubled sectors of the real estate world, you want to keep your occupiers going. So someone who needs a bit of help, you're going to help them through. The last thing you want to do is create an empty shop or an empty warehouse or an empty office just because they haven't paid their rent. But so it's been a really interesting experience, and it's really we felt we benefited massively from the close relationship we have with our occupier base. I mean, that's critical. You've got to know your customer. You've got to know, I think we've learned we need to know them even better going forwards. And we probably need to be more innovative in thinking around how we collect and how we bill rents in the future.
It's fascinating to listen to this. Here we are in the greatest crisis of various of our generations. And yet, perhaps because you are amongst the largest and best capitalized players, the story we're hearing is that between help from the government, or perhaps not so in the UK, pragmatism in terms of working with some of the customers, notably in shopping centers, to help them stay in place, that actually the cash flow situation's not that bad, that rent is largely getting paid with perhaps some adjustments in a sector or two. Is this sustainable? Or is this just a short-term impact? The governments can't fund the underlying tenants forever. Are you worried that all we need to do is wait and sit for the other shoe to drop?
I think from my perspective, as long as we can see that there is a pickup in the market activity, and we will, as long as we don't see the second wave coming in, I think that the companies will do better day by day, and we expect actually everything to improve onwards. So we have quite a positive view on the market development. And in Sweden, the state has not helped out that much when it comes to rent reliefs or helping out companies. So it has been very, very limited so far. But as you know, Sweden is quite a rich country. The state debt is very low, so there is a lot of more gunpowder to put in if we would be hit by a second wave as hugely as the first wave was. So I'm quite positive that we'll continue to see a day by day small but positive improvements in the market in general.
Olivia, how do you frame this question? Kind of think about the short-term impacts, the long-term impacts. How do you conceptualize it?
So look, I think the question you're trying to ask here is this time different than what we've been through before? And actually, I think the answer is both. It is and it is not at the same time. It's not different because it always started the same way. There is a global event where some call it the Black Swan event, which was the failure of a major investment bank 10 years ago, 12 years ago. Now it's a global pandemic. And that event basically translates a few months later into a recession. And we tend right now, I think where it's different is that the initial event that we had was not one day, it happens and then we move on and we look at what the consequence and look through the rumble. It's just staying with us for longer. And I think we should not confuse the impact of the pandemic with the impact of the recession. And I'm much more worried about the impact of the recession. I mean, maybe 4 or 5% GDP decline in Sweden is, so far so good. In Germany, it's the worst decline we had since World War II, and it's not good. It cannot be good. Office is it's a cyclical asset class. And I think, so if we stop and just look at the pandemic, we're basically missing the bigger picture. And we know how recession plays out. A recession is going to have impact on the demand, on the tenant side. It's going to have an impact, potentially create some distress. I mean, we can argue there's less leverage in the system. But we also know that the central bank are already firing as much as they can. And there's already all the tools has been deployed. And again, this is different from what it used to be before because we are already firing from all sides. So I think looking into the future, I'm much less concerned about the pandemic because I'm confident enough that within the next 12, 18 months, they're going to be a vaccine and we're going to get out of the health situation. Yes, there is a lot of uncertainty, a lot of risk associated with that. There's going to be a lot of volatility along those 18 months because of the uncertainty linked to the health situation. But then after that, there's going to be a recession and maybe it's going to be L-shaped, V-shaped, W-shaped, I-shaped. I don't know what kind of shape it's going to have, but a recession, at least on the office side, always have the impact that I was describing before. It offers both opportunities and also a lot of risk. And finally, which is also always the same thing as well, is out of this recession, what usually happens is there are a certain number of changes which are more systemic and underlying that are going to last and overcome the recession. This in our space, you're going to have the work from home, which I'm sure I'm going to discuss at a later stage. This is potentially something that is going to last longer. But if I look into the economy, into the wider economy, I mean, the automotive industry is accelerating its transformation because of what's happening right now. I mean, airlines, the hotel industry, all of those things are going to go through massive structural change, which is probably going to survive past the recession. And those things are things we will need to adapt in the future. So it is actually pretty much the same that what happened in the past in the same crisis. The impact are going to be different. And I think the kind of the movie is I mean, the plot is the same, but the movie is different. The character are different. So I don't think it's different, and I'm actually much more concerned and looking more into what the impact of the recession is going to be, not so much about what the pandemic itself is going to be, which was a lot of the conversation of the introduction actually.
David, would you agree with that? That the economy is more important than the pandemic, or do you think there's actually other long-term transformational changes that you refer to that matter?
Yeah, no, that's a great question. I mean, I think obviously the near-term impacts of the pandemic and the economic consequences are what everybody is most focused on right now, understandably so, and that's where most management effort and resources is going into. Yeah, but I do think we need to look longer term, and the interesting thing to me is what are the changes that will be what is this a catalyst for? What will be accelerated, or what will change that we weren't otherwise expecting? Because we will get through the pandemic, we will have a recession, clearly most places, but we'll get through those. As a long-term investor, and most of the people certainly on this panel are longer-term investors. The interest to me is on what changes happen as a result of the pandemic that get accelerated. Certainly, in our own space, obviously, e-commerce penetration has really spiked. Will it stay at the current elevated level? No, but does it mean that probably the rate of growth going forwards and the rate of penetration increases? I think it will, but there will be other changes too. So I think for our particular subsector, it's it's a positive in the near term, as we've talked about, on a relative basis, and it's probably positive on a longer term basis. And I think we've all got to make sure we stand back and think about what's going to be different in the future. How are we going to work, live, and operate differently, and adjust our portfolios and our strategies accordingly.
Do you think that's going to change the nature of the logistics product, the location of it, or the way you operate? We've touched a lot on flexible leases.
Well, it's interesting, in the logistics market, when I joined the industry 15 years or so ago, we were at the tail end of the decline of Western European manufacturing. Leases were getting shorter, vacancies were getting higher, and of course, it's now in a very different place, where it seems to be at the sweet spot of some of the digital revolution and other changes that are happening in society. And therefore, we're one of the few sectors where actually leases are getting longer. And one of the reasons for that is, of course, there's a lot more automation, a lot more technology happening going on inside buildings, because that's the way you drive efficiencies. Actually, it's the way you future-proof them as well. The less labor you have in your warehouse, the less vulnerable you are to not being able to get your staff there when you have a pandemic, for example. But it also drives efficiency. So there's a lot more automation, a lot more investment inside warehouses. They're getting bigger, they're getting taller, quite often multi-story, and therefore leases are getting longer. So at least for part of the, but not all of it, but for part of the occupier base, that's what they want. So yeah, the industry is changing, but for us, what we're focused on is pick the big urban centres. We've got about 15 or so big urban centres around Europe that we're targeting. Pick the big population centres, and also and try and get into those edge of town, inside the cities, around the edge of the big population centres, as where we focus out what we call our urban portfolio. Some people call it last mile, and then also think about the very big logistics corridors and really pick the core locations. There'll be demand and changing demand patterns across all of the markets, but if you stick to those really core locations, we think that's a strategy that if you overlay on top of that very relatively generic buildings, very modern, specified, then the occupier base will come and go, will ebb and flow over time, but fundamentally that's a good place to deploy our capital. But it's changing, and assets that we acquired 5 years ago that we thought were really great core assets, we've sold in the last year or so, because we can see that they've done their job for us, and there are probably better owners of those and better places for us to deploy our future capital into.
Okay, interesting questions about the change in the product. Biljana, how do you see the future of office? If we listen to the journalists sitting in their back garden, office is dead, even cities are dead. The population centers that David was referring to that we need to chase. Is that what you see happening, or what's your view of the future of the office, the product and the location?
No, offices are definitely not dead. I'm actually at my office. I have colleagues running around here in the corridor, so it's quite a big activities. I mean, in Sweden, if I look at our tenant base, not a single termination of a lease agreement have been made by a tenant because of the virus. Not a single, and we have 1,600 lease agreements. And I think that we are in some kind of a shock slash wait and see slash what do we do next mode, and will be so for 1 to 2 years. And then we will thereafter, then we will continue with the trends that we have seen in Sweden. And that is that people are working from home, and people are working from offices, and people are working from some kind of hubs close to their homes. So we have a variety of where you can work from when it comes to offices. And we have had this decline of amount of square meters per employee for many, many years. I think that trend has been going on for 15, 20 years. And I think in Stockholm, as an example, the average square meter amount per employee is 10, 12 square meters, but with a huge variety. I mean, our tenants, 85% are private profit-driven companies. They have actually even less square meter on average per employee. If you look at the public tenants, they are not there. They have not this efficiency in their, genes, so they can have up to 30, 40 square meters per employee. So no, talking about safe public tenant properties, they're not safe at all, I would like to say. They have not even started to get the shift in, efficiencies. So I think that over years, we will see that trend just continue. But on the other hand, at present, we are actually in negotiation with a research company to sign a new lease. They have 50 employees, and the whole business can be made for them if all their employees are in the office. So for very first time in 3 years, we are actually looking at a tenant and want to have office space individual for each employee. That has not been the case for 3 years with us. So you see, there is, I think that the tenant demand will be very complex in the future. You will have tenants that want to lease short on flex leases, maybe 1 month, 3 months at a time. And then on the other hand, you will have tenants, companies that really, in order to drive the business, they need to have their teams in place. They look at the health issues more seriously today, and they will have more space per employee, perhaps not, your own room or even your own desk, but huge common space, meeting space, creativity space, whatever, in order to attract people to come and do good business and do deals, and everything in between. So that is somehow what we see in front of us. And I think that as long as we don't have an oversupply in the market, I mean, in Sweden, in Stockholm, as an example, the whole inner city, the vacancy rate has been below 4% for years now. I mean, the problem that the retail sector has had, it was the oversupply combined with structural changes, combined with e-commerce. So a lot more, so to say, challenges than we have in offices. I think the development that we have seen many, many years, at least in Sweden, that will just continue once we are out of this kind of a shock, wait and see phase that we are into right now.
Ismail, you've got, if not the largest office portfolio in Spain, certainly one of the largest, and undoubtedly the largest development pipeline of office, particularly the north of Madrid. How are you going to evolve that product for the future of office?
Well, it's a little bit too early to respond with a lot of weight in what I say, but we are seeing a number of trends that I believe will become more important in the future. The most important that we were already seeing pre-COVID and now is intensifying is open and clean areas in Spain, including terraces. You cannot imagine how important it is now to have terraces in good quality offices in Spain, because most people now want to hold their meetings in the open air, and they want to socialize in the open air. So, the floors which are contiguous to a good quality terrace now sell for incredible prices. Another interesting trend that we are already witnessing is the regained importance of parking. So we had some buildings, particularly high-rise buildings in Spanish or Portuguese gateway cities, in which our tenants were tech companies and parking was completely useless. I mean, we had 100% occupancy in the building, 30% occupancy of the parking because everybody was coming with a bicycle or with a roller or whatever. Now, all of a sudden, most of these people is now even scratching their own personal pocket in order to pay for a parking slot because they want to park their own car and come every morning listening to their favorite music, a little bit Los Angeles style, you know, and they like that, and this probably will take some time to recede. It is also true that peripheral mass commuting systems, like what we call in Spain cercanías, which is air train, is now favored to the people rather than tube. So people doesn't want to come to the real city center of Madrid because they prefer to be a little bit more peripheral and come through the air train. They prefer to go to the office in what we call here the green buses, which are buses with predefined seats. So where you can sit and somebody can sit, or if for the reason of COVID, one of the seats is nullified, there is one person, nobody, another person. But they don't want to go in the blue buses, which are the ones in the city center, where you are basically standing and you have somebody 20 centimeters from your face. So those things are clearly changing the way we will treat our office portfolio in the future. Individual boxes, so offices, are regaining a lot of importance, particularly with consultancy, investment banking, and law firms. So all of a sudden, the partner of a law firm says, if you put me in hot desking, if you put me in open space, your mother is going to come to work. So basically, this is making a lot of the bosses to rethink how they distribute the space among particularly the most senior people in the office. And the most recent trend that we have seen is that authorities are no longer happy about excessive densification. So we recently got a license for a super duper consulting firm in Madrid at 7.2 square meters per employee. Many people believe this is a lot, but when you take out common areas, call boxes, the restaurant and the offices of the bosses and the corridors, that is 70 centimeters, 80 centimeters between employees when in the open plan seating. So the authorities are already warning us that those licenses were started before COVID, but you know, on a post-COVID environment, we are not going to get licenses for 7 square meters per employee, and they are pointing towards the legal regime till 2010 in Spain, which was a minimum of 10. But this is extremely important because, you know, all across our portfolio, the average is in the region of 9 because we almost do not have public sector tenants. So all of them are what Biliana said, for-profit, private companies. So if the average of 9 all of a sudden moves to an average of 10, the net new absorption is very significant across the portfolio. So, you know, this is very important, and it's also giving wings to our flex space business, which suffered a lot in the pandemic because people basically canceled the contract. But it's very easy, it's by the week or by the month. So people cancel the contract. But after the pandemic, many companies are seeing that their HR department says, okay, we have in the campus 4,000 employees, but we can only sit 2,000 with the new sanitary measures. So where do you put the other 2,000? The immediate reaction is at home, but nobody wants to work at home forever because you start immediately feeling like a B-class employee and everybody wants to come to the headquarters. And as such, people is starting to contract blocks of office space. I want 150, I want 80, I want 75 in flex space modality, which is an early indicator eventually of future demand.
Interesting point. Mahdi said earlier that COVID accelerated trends. There's an argument in office that it reversed the trends. Less densification, going the other direction. Used to be more social space, now it's less social space. More open plan, now it's individual office. So that's one sector where it's arguably the way around. Olivier, I know you're doing a lot of work on flex space and what the future of office looks like. You want to wrap up with some of the comments in terms of your vision of the future of office. Why is the journalist wrong?
I have a slightly different view. I think all the things we just discussed are short-term impacts of the pandemic, and those are going to fade away. So the fact that people are looking at expanding today is, yes, there is social distancing. People need to be far away from each other, but the city center is still the city center. And people are still going to be willing to be in the city center, because you're not in the city center because it's nice. You're a city center because this is where your lawyer is, your banker is, your marketing agency is, and if you want to meet them and don't do everything online, then this is where you need to be. Densification also makes sense in the office. There is some kind of benefit into that in the long term, and I think we're reacting here from a position where we're living in a world where we should not be touching anybody, we should not be taking public transport, but public transport is still the most efficient way to work in an environment. And yes, so I think they're going to be short-term consequences, and we need to deal with them within the next 2 to 3 years. I fully agree. Tenants are going to be asking more space, but work from home, I believe, is here to stay. And what we're looking at as a company is how can we create a symbiosis, to the Swedish example, where people work both from home and from the office. And our job is to make that happen. And when we look at work from home, what it means desk sharing, in essence, if you convert that into an office space. And so how can a building actually allow for desk sharing? Is desk sharing even worth it? I mean, you do, if you think about desk sharing, you basically have 20% of your people which are not in the office at any given moment in time, but they still need to have a place to store their computer, to store all their paperwork, etc. And that's going to take space. So the kind of space saving is not necessarily good enough. As Ismail said, some people just don't want to share desk, and therefore, is this going to be an acceptable? Am I, as a corporate manager, willing to go through the pain of having desk sharing, or am I just better off like renting 20% more space, which I know I'm not necessarily going to need? And what we see today with our tenant in Germany is just that they just have no idea. And the leasing market today in Germany is just frozen. I mean, there are a few deals here and there which are taking place, which are usually things which are very, very specific. But the large corporate, they just have no idea what they want to do. And we're seeing a massive increase in tenants saying, can we extend the lease where we are? Because this is my best move today. I mean, my best move today, given that I don't know, I just stay where I am, and nobody's going to yell at me because I stayed where I am. But do I want to rent today 10,000 square meters for 10 years and then realize I only need 6,000? Or do I want to take the risk to rent 6,000 and then realize I need 10,000? So, I mean, we in the real estate, I think we need to acknowledge that we're very, very slow people. We're not made to react on the spot to something that happens. It takes us, I mean, look at how prices developed in 2008. I mean, it took us 3.5 years to realize there was even a crisis out there. So it's going to take us time to figure out what exactly all of what we're going through right now mean for us. And if you go beyond the PR discussion and all this, you're going out there and explaining that they're going to allow their employee to work from home. I mean, we went through the exercise ourselves. We're allowing our employees to work 2 days per week from home on a flexible basis. I mean, the legal environment is unclear. Who is responsible for what? I mean, you're responsible as an employer of the safety of the technical equipment of your employee within its own home, but by constitution in Germany, you're not allowed to go into the home to check that. I mean, so the whole thing just needs to be thought through. And I think there's a lot of things you read out there which look like, it's black or white. It's either you work from home and then there's the death of the office, or you don't work from home and then office is going to survive. And I think at the end of the day, it's going to be a bit of both. And our best move as office company is really to try to find this symbiosis about how to help our tenant to work in both ways and allow the space to be attractive. When I come to the office, I want to have an office that I want to go to, because the thing I need to do in the office, I want to do in the office. And then there are a number of things I don't need to be in the office to do, and that's fine. I mean, I save 30 minutes, an hour of commuting. I can spend more quality time with my family. I use less CO2 because I'm not polluting with my car. So that's also fine. And those things I think are both good for our business. It might translate into a bit of lower demand, but I'm not sure we are the one which are the most impacted. I mean, I noted, and I'm just going to stop on that and hand back the mic, but I noted earlier in the introduction, I don't know which one said, I mean, we need to know if we're less like bonds and more like equity. I mean, of course we're equity. We're not a bond. I mean, David, what just said, what was a core product 5 years ago is now something which you need to sell. And this is not characteristic of a bond. And if you still look at real estate as a bond, you're like 25 years too late. That was 25 years ago. Today, real estate is equity. It's an operational business. You take a whole lot of risk when you invest in real estate. And if you don't have an operator, if you don't have somebody who is comfortable with taking the risk, then you should be elsewhere in tech.
A lot of questions embedded in that underlying concept about the nature of real estate. That's a whole other session in of itself. Let's finish off then with the classic question. One question and one word answer, please, to finish off. What keeps you up at night? COVID, economy, the future of real estate, Brexit, or something else? Ismail.
Public markets. I believe there is a fundamental discrepancy these days between private markets and public markets. Public markets have chosen a number of reasons to be worried about, be it retail apocalypse, be it permanent work from home, as Olivier was saying, and they are completely clueless in terms of order of magnitude. So, since they do not know about order of magnitude, they say, okay, shopping centers, I don't quite like that. So I put a 0 on that, on the value of that portfolio. Offices, there could be some work from home. I will, cut by 30% the values. And logistics, well, it's a good thing, but still, I will, knock out 10% because it's 2020. So at the end, when you put all that together, you go to incredible discounts between public and private markets, and the big seasoned expert asset gatherers are going to take advantage of that. So, because there is some people out there who has been in real estate for many years that do not necessarily follow public market research. They have their own view about everything, and eventually they may take advantage.
Let's have a follow-up conversation, Ismail. David, what keeps you up at night?
Oh, well, actually, you're saying I've had a good pandemic. Not much these days, because I've really enjoyed working from home, having a very comfortable environment to work in, and less commuting and healthier air. But like everybody, I want to get back to the office and I want to be able to network with colleagues. But I've been sleeping well. But I think in terms of the challenges ahead, I think the one thing about warehousing and logistics is, nobody wanted to touch it 10 years ago, and not many people 5 years ago. Now it's a very crowded space, so it's competitive, and we have hard work to do to keep finding good investment opportunities, to find good land opportunities, to actually recruit, retain, and motivate our people, because everybody wants a piece of the action in warehousing and logistics. It's a popular space, so that's one of my biggest challenges and concerns is managing through that. It's a high class problem to have, but it's still a challenge.
Olivier.
I mean, the single most thing that keep me up at night is climate change, is the long-term impact that this is going to have on our business. If we want to reach the goal of the Paris Agreement, you basically need a pandemic every year to basically allow us to get there. And that I found is a scary thought, and the potential civil unrest and political instability that's going to come out of it, I think is one of the most scary things from my perspective. And unfortunately, there is nothing much that we can do about it individually. I mean, we try a lot, but it's going to be a kind of a combined effort to try to get there.
And the last word, Biljana.
Well, you have said it all. So I think all these things are very relevant and on top of my mind as well. Another thing that may be added is the globalization that has given us so much economical growth worldwide. And I think that the trend now is that the globalization may decrease. And with Trump in US, Putin in Russia, and so on, I think those consequences, for me, it's very difficult to see how that will affect our economy in Europe and in Sweden.
Fascinating. Not a single person cited COVID. Not a single person cited Brexit. Someone said earlier that perhaps in real estate we're slow, but I'm going to say it's not that we're long-term thinkers, as demonstrated by this panel. I'd like to thank all of the panel members here. There's been some really interesting thoughts from both an operational, a product, and a long-term strategic thinking perspective. Very interesting, and thank you. I certainly learned a lot, and I'm sure our audience did as well. So thank you to each of you, Ismail, David, Olivier, and Biljana. And thank you as well to the organizers here at EPRA. And I'll pass it back to Alex and to Roxana.
Thank you.
Thank you. Bye-bye.
Thank you, folks. And once again, thank you very much for participating. It's been very interesting.
Thank you.
Likewise. Take care.